GM, good morning. Welcome to the Milk Road Show, the daily crypto show for anyone who thought I could turn this $800 into generational wealth. I'm your host, Jay Hamilton. It's Monday, August the 11th. Just a few weeks ago, the Genius Act passed. It is now signed into law, and overnight, it is starting to rewire the entire stablecoin market, as well as impacting the entire financial sector and banks in particular. Now, some projects and some institutions and some incumbents will thrive, others will vanish. And investors, you're all asking one thing: what's next? So today we're joined by Mike Belshe, CEO of BitGo, to cut through the noise and find the signal. He's one of the sharpest minds in crypto, and he's going to walk us through where stablecoins are right now, who wins, who loses, and how to position yourself for the next big move. Now, before we jump in, if you are making moves with your portfolio right now, I highly recommend that you check out Milk Road Swap, not only because it's our product, and obviously I want to endorse our own product, but more so because it has some of the cheapest fees in the space, and it is incredibly easy to use. You can swap on Ethereum, Base, Arbitrum, and Solana all in one place with much lower fees than most of the exchanges out there. So check it out today. Today's episode is brought to you by Figure Markets. Grow your cash like a bank. No lenders, just real returns. It's also brought to you by Nexo, the platform that grows your crypto without locking it away. Without further ado, Mike, welcome to the Milk Road Show.
Hey Jay, nice to see you. Great, thanks for having me.
Yeah, pleasure to have you. You've got one of the best backgrounds we've ever had on the show. I wish I was sitting in front of palm trees like you right now. For everyone not watching, make sure you check out the video to see Mike's face. It's looking good in the background. Okay, Mike, let's just set the stage before we jump into the Genius Act and the impact and stablecoins. Over 270 billion now at an all-time high. Incredible to see the growth that's happening with stablecoins. But before we do, I just want to set some context. Can you just give us a little brief background on yourself and what BitGo does and how you have involvement within stablecoins?
Sure, absolutely. So my name's Mike. I'm co-founder and CEO here at BitGo. We've been doing this for about 12 years now, and we are an infrastructure provider for digital assets. So we've been providing, self-custody wallets, of course, custody wallets, services on top of that. We have a stablecoin as a service product, a crypto as a service product. These are all different ways that companies and businesses, we have the largest client base of institutional clients in the world, bar none. And we have a number of different ways that folks can interface with us. A little bit about me. I'm not a finance guy. I'm a technologist. Started my career as a engineer at Hewlett Packard here in Silicon Valley. I had, classmates in college that went off to work in finance. I was never interested in finance because, to this day, I still believe, and in fact, maybe now that I know a little bit more about it, finance, it leeches off of those that actually build stuff and takes money, kind of takes some of the cream at the end, which is an interesting dynamic. But I do find myself in finance because, after having had a career in Silicon Valley for 30 years, like I said, first at Hewlett Packard, but then I found this company called Netscape before it was a public company, did a bunch of startups, sold one to Microsoft, was part of Microsoft for a little while. Then I went to Google just as they were starting a browser, which was later named Chrome. When I found Bitcoin, I was excited about money inside of our computer. So I was excited about it from a technology perspective. And in fact, like a lot of people, we call it, jumping down the rabbit hole. Which is you start to think about, wait, what is this money stuff that, I haven't been interested in my entire life? And we're pursuing it every day and we don't really understand like how it works, how it came to be, whether it's a good tool for the job in front of us or not. So anyway, as we talk about stablecoins and finance and like, what should markets look like? I'll say this to folks that come from Silicon Valley. Money and markets are a systems type of problem. Actually, I think computer scientists are extremely well suited for figuring out what the financial markets of tomorrow should look like. The markets that we have today, I'll give you a quick question after this, Jay, a funny one. But the markets we have today, primarily built off of, the Securities Act of 1933, the Exchange Act of 1934. I'm pretty sure we didn't have computers in that era. So if you're designing a system with computers versus without, you're probably going to come up with some different answers. And here's a funny question for you, Jay. Who do you think was the first commissioner of the SEC?
I don't know.
So it was a guy named Joe Kennedy, aka JFK's father. And here in America, there's a funny story about Kennedy, and they made the money off of bootlegging. Well, little known is they also made the money off of being fantastic front runners, pump and dumpers, inside traders, etc., all through the teens and the 20s of the 1900s, and it was not illegal. So there's nothing you can't criticize them for it. It's that you were allowed to do this. And then we had the stock market crash in 1929, and then there's a bunch of people saying reform, 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 and they said, okay, we're going to build this thing called the SEC to help give us some oversight and prevent bad information being out there. Who knows how to build this thing? Joe Kennedy. Let's call him up. And he did a great job, by the way. I don't want to dismiss any of the great work that they did. I think actually the framework that they put in place has created the greatest capital markets in the world, bar none. The U.S. is way ahead here. It's not even close. But all right, can computers change things a little bit? Yes, they can.
And I think everybody listening to the show is going to agree with your overall statement that it is time for a change within our financial system. We don't need to dive deep down the
Such a
rabbit hole
controversial statement.
of why, but where we are right now. But it's certainly we are there. So let's use the Genius Act as sort of a jumping off point into the stablecoin market. So let me ask you this: how did the Genius Act passing change the conversation? And maybe actually, I almost wonder, feel free to go back a little bit further to the other big stablecoin milestone that happened, which was Circle's IPO. And if you want to use that as the launch off point, feel free to do that as well.
I think if you want to talk about stablecoins, you really ought to go a little bit farther back. Tether deserves a ton of credit for having pioneered stablecoins through the 2010s, and they did so during a zero interest rate environment, which means that they weren't making any money off of the treasury at the time. In fact, if you could just go back just a few years, there were worries about having negative interest rates. We had negative interest rates in a number of countries around the world. What do you do with a stablecoin if the interest rates go negative? Of course, I don't think there was ever much danger of negative rates in the U.S. The economy's a little bit stronger, but nonetheless, so Tether pioneered this thing, and we also had a complete lack of help from regulators saying, like, what do you do with this thing that's a stable coin? And how do you regulate it? And is it safe or is it not? So one of the core features that Tether created was they ran it completely outside the US. They completely avoided US companies. And they said, hey, we're going to create a really stable dollar that's digital, that's usable everywhere. And we're going to make it so that it's completely safe in case the US banking industry kind of goes crazy and somehow lobbies a strange law. So, all right, so they pioneered it. They got in early. There was no money to be made. And then all of a sudden, over the last 5-6 years, as the interest rates have climbed on the dollar, obviously they're looking at a really, really pretty spot. Circle came along. I don't know exactly when they came along, what, 2018, 2019? Actually, Circle pivoted a couple of times. Initially, Circle was doing some completely different work, brokerage type work. They bought an exchange. They did some things there. Eventually, they settled in on stablecoins and hit their groove. And, Jeremy Allaire over there, a fantastic innovator, technologist, building payment systems, very good at it. And they've grown to be a bit of a juggernaut. All right. So then over the last couple years prior to the new administration, again, kind of, not a lot of regulatory movements. Banks are being forced or strongly encouraged by their regulators at the OCC, at the FDIC. Thou shalt not touch digital assets and crypto. Of course, Senator Elizabeth Warren, very negative, along with a number of others. Started to become a little bit of a political thing. The Biden administration, Maxine Waters, Sherrod Brown, Brad Sherman, like all these guys, super negative on crypto. We've never had technology or an asset class persecuted like this before. So stable coins looked like they ought to be the easiest thing for regulators to get their heads around. And yet it was being lumped in with all digital assets and therefore bad. No explanation of what you should do with it, how it should work or not, almost like they just want to block it. All right, well, we have a new administration. And of course, BitGo, myself, a number of people from the crypto industry were pivotal in the campaigning this last year. Look, I strongly believe business and politics don't really mix. There's some overlap when politicians are coming after your business, but in general, you try to stay away from politics. We're here to build a great business. We're not here to, fight about how the government should be run. Everyone should have their own opinion on that. But we had a very unusual case, and while everyone was looking at Gary Gensler at the SEC last year, and you heard a lot about him, he's very public. He sued a lot of good crypto companies. People didn't hear as much about what was going on in banking. Now BitGo saw it. So our regulatory framework is we center around custody, and as a qualified custodian in the United States, regulated under New York DFS, regulated under South Dakota Division of Banking, a bunch of other regulators also. But it's clear we can hold securities. So this was never an issue. We never had any run-ins. I met with Gary a few times, all as part of trying to promote crypto. But we did see a problem in the banking sector. So the OCC was run by this guy named Michael Hsu, and he went to all the federal banks and said, you cannot touch crypto. They passed a thing called SAB 121 at the SEC, which created a bunch of confusion and was a sideshow. But, that held things back. And then the other one was FDIC. And, I think maybe some of the people on this podcast might find this interesting. We think in the US that we have a separation of federal and state powers. And of course we do. But when it comes to banking, look, there's federal banks and there's state banks. There's a bunch of great, state banks. You might have heard of them, Bank of New York Mellon, that are not chartered under the OCC necessarily. They're chartered instead through the states. All right. But FDIC, Federal Depository Insurance Corporation, pretty much every bank, whether you're state chartered or federally chartered, has to have FDIC insurance. You're not a very good bank if you don't have that. But what FDIC is essentially it's an uncapped insurance policy. People say, no, Mike, it's capped at $250K per account. Yeah, I get it. But it's uncapped on the number of accounts. You can't go get a commercial insurance package, which is uncapped on number of accounts or dollars under the accounts, et cetera. So every bank in the US is subject to needing FDIC practically. And when the FDIC comes along in 2022, and says, if you touch crypto, we are going to scrutinize your business. Well, half the state banks dropped out, right? Mm-hmm. So you had all the federal banks out from the OCC. You had half the state banks at least out because of FDIC. And so this led us to a place where we just we need somebody new in charge, man. These positions are all filled by one guy, and that's the president of the United States. And so we need a new president. It was as simple as that. All right. So finally getting to a long-winded answer about where are we now? Everyone recognized that stablecoins ought to be easier for lawmakers and regulators to get their heads around because it's dollars, right? It's a relatively simple wrap around dollars. They ought to be able to put something together. The previous administration did start to work on it. We started to see some proposals coming through the House, the Republican side, in the previous administration, but then finally we got this through. And then the Genius Act is super enabling. All of a sudden, we now have a clear guidance in the U.S. for how do you touch digital assets. I don't think Tether has finished making their moves yet. I suspect that they will be able to come into the United States finally, either with a U.S. product or their existing product, one or the other. Every bank in the country is now drooling at how do they get in on this. Interestingly, I think the banks don't quite get it yet. There's some fights that are happening. All right, I'll stop there because I talked for a long time. I'll let you ask, but we can talk about what those fights are or whatever you want to go to.
Why do people invest in real estate? Because it spits off cash flow. But I'm not here to manage rental properties. That's why I'm looking at Figure Markets. Their new democratized prime product backs your money with real cash flowing assets and returns up to 9% APY. It's the first real world asset borrow lend pool built for everyone, not just institutions. Ready to lend like a bank and get more than the 5% Aave is offering you? Download the Figure Markets app today and get 9% on your idle funds. Go to milkroad.com/Figure Markets.
If long meetings and judgmental bankers are your thing, Nexo's probably not. Nexo is a premier wealth platform built for people who value their time and money. It's built for people who have idle cash lying around and want it to grow fast. Whether it's Bitcoin, Ethereum, or even Forex-pegged assets like USDT or USDC, Nexo offers up to 14% annual interest and access to crypto-backed credit in under 24 hours. Your assets need a platform built for growth. Join Nexo.
Yeah, that's exactly. Let me tee it up, but you're leading perfectly into my next question, which is, okay, we've fought to get to 270 billion in stablecoins, right? Which is, when you consider all the things that you're saying, all the mountains we had to climb, all the pressure pushing us down, it's remarkable in a way that we have gotten to this point without there being clear regulation. So I think two things to break down. One is, let's talk about the banks and what happens next. Over the next 5 years, are we going to get to the trillions? What does that look like? Do the banks play ball? What are they fighting about? Let's break that down.
Yeah, well, look, so stablecoins turn out to be just better banks. And we are on a path which is going to completely dismantle the way you think about banking today. And we're going to have different services around it. And stablecoins are the key first step. In particular, what I'm talking about is, when you think of a bank, and a bank is a depository, that means they can take your assets, they can hold your assets, and they can lend them out. The depository is allowed to lend them out. Stablecoins are purely better. Stablecoins, they're one-to-one backed, 100% by, short-term duration T-bills. T-bills, of course, are cash. That's risk-free. Number two, they can generate the risk-free rate, 4% right now. Banks, on the other hand, they're fractional reserve, and they give you 0.1%, meaning they take risk to give you way less. And then number three, of course, stablecoins are so much better at payments, 24 hours a day, 7 days a week, almost no fees, and global. Banks are so bad at payments that PayPal exists. They're so bad at payments that Cash App and Zelle and Venmo and the list goes on, Plaid and Stripe. Like, none of these guys should exist if the banks were just doing a decent job on payments. So we all know they're not doing a job on payments. All right, on the middle one, can they give you a risk-free interest rate? Well, this is a place where we saw a little bit of fighting. The banks came in at the very last minute on Genius and said, we need a little provision in there that says these stablecoins can't give interest rates, because if they do, it's going to eat on our business. Oh, no, wait. If they do, it's going to break the banking industry. There's going to be a run on the banks. It's going to hurt the economy. They always have to say it's going to hurt the economy, because otherwise you wouldn't care. But I believe very strongly it's just a matter of time before we have like real interest rates directly on stablecoins, on chain, et cetera. So we have a little bit more fighting on that one to do. By the way, there's an analogy, and you should look back at what happened with T-bill backed money markets that came to life in the early 1970s. The exact same pattern happened. So back in the early 1970s, just to give a little more history, there was this thing called Regulation Q. It no longer exists, but Regulation Q said that banks had a limit on how much interest they could give back to retail. And as we started to have inflation and the risk-free rate on T-bills exceeded the limits that banks could give for interest via Regulation Q, these smart guys came up with this thing called a money market. And they said, what we'll do is we'll have a T-bill backed money market, and we'll give an interest rate which is better than the banks. And everybody's like, oh my God, no, there's going to be a run on the banks. Everyone's going to pull their deposits out of the banks. They're going to put them into these things to get more interest, and like the world's going to end. Of course, that didn't happen. And today there's lots and lots of money markets you can get that are T-bill backed, and it's all just fine. The same thing's happening right now. The initial reaction is that, like, hey, here's this change, and people are worried that there's going to be a run on the banks. I don't think there will be a run on the banks, even if there were. We have better ways to deal with banks now than we did in 1970. But the banks have a slightly different worry. They're not really worried about a run on the bank. What they're really worried about is just losing deposits, and they want the money, and they want your money, and they want to be able to give you 0.1% interest and call themselves a fiduciary when they could have literally just put it at the Fed and made 4% and given it to you. Like, okay, they just did a bad job. It's as simple as that. Mm-hmm. And, they've gotten addicted to having free, easy money. They take it from you, give you nothing. They don't give you good service. They don't give you good payments. They nickel and dime you even when you want to go to use the ATM. All right. So we are now in the first phase of fighting. And maybe the sad news for everybody on this podcast who's probably very excited about, disrupting banks. This is probably going to take more than a decade. The banks are not going to just sit down and say, oh, well, there's a new technology. I guess we're done. No. They're going to fight, and they're going to fight for a long time. Now, by the way, the first thing that they always pull out is not how do we fight by building great products and like delighting our customers. Instead, the way they want to fight is they want to go to their regulators and the people that they pay politically, and they want to say, build me some better regulatory moats. I need more moats. They're getting across my moats. And that's exactly what they're doing. That's exactly what happened in the first salvo that was sent across with the Genius Act. There's been others. There's CEOs of banking companies that are proposing that you shouldn't be able, as a private company, to buy short duration T-bills and bypass the banks. You should be required to put your stablecoin reserves in banks only. And by the way, this is not just US. Remember, this fight's going to take place globally. So in the EU, if you want to get an EMI license, an electronic money license, for stablecoins, which is required if you want to be traded as a stablecoin issuer in Europe, you're required to keep like 60% in banks instead of in treasury type products. So this fight's going to continue for a while. The banks will initially pull out the how do we fight just based on give it to us, please, rather than how to make better products. But look, how did stablecoins get to be, 270 billion or whatever size it is? Because the product's good. People want the product.
Yeah.
And, there's an opportunity here for the US and US lawmakers to really recognize if you embrace stablecoins and you allow interest back to retail, which is, you absolutely should. It's their money. Of course, you should give them back the interest. But if you allow this, you will be able to export dollars across the globe. And this will be the beginning of the U.S. becoming the U.S. dollar becoming the last remaining fiat currency. I strongly believe this. I know that China will be kind of the last one to give up. All of the other fiat currencies are weaker than the dollar, and they will start to fall. And all you have to do is, if we give risk-free 4% interest back to people around the globe via stablecoin, we make their lives better, and the U.S. dollar wins.
Your mention of this opportunity that stablecoins presents for the US dollar to continue its dominance as the global reserve currency, I see that. I think all of our listeners see that. I've heard Scott Bessent say that he says that. Does everybody in Washington and at the banks see that?
Well, the banks don't care if that's true. They just want to preserve their business, as they've done for a long time. So they're in a different position. By the way, it's pretty much innovator's dilemma, but with regulatory wrapped around it. The innovator's dilemma deals with this case we've seen in Silicon Valley for decades of why is it that this big company that has all the money, all the resources, all the abilities, all the know-how can get beat out by smaller companies that are innovating. And it's because initially the innovation is at the small scale. And so they have to iterate and iterate and iterate. And by the time it becomes big enough scale to be interesting to the banks or to the incumbent, it's too late. The small guys have iterated and learned too much. I think the real thing to focus on, though, is not what anyone thinks, but let's just talk about the data. So we had, like I said, a zero interest rate environment, and we started to peel off of that in like 2022. And, the reserve rates on the dollar started to climb. And as soon as that happened, of course, the dollar gets stronger globally against other fiat currencies. And so you immediately saw, early elements of hyperinflation, but massive inflation spikes in Turkey, in Venezuela, in Argentina. Basically, the folks that had weak currencies, all of a sudden, they were seeing massive inflation as their people were just clamoring to get somewhere else. And in a lot of cases, where did these guys go? Like Turkey is a great example. They went to Tether. Now, people have a hard enough time understanding Bitcoin, much less like what is a stable coin. But imagine, put yourself, on the ground in Turkey. Your local currency is inflating at double digits. Your wealth is disappearing. Your ability to send your kids to school next year is questionable. You will do anything to preserve your value. You are looking for some way to solve this problem. Now, this isn't new, right? It's happened before. We just have a new tool on our belt, which is the stablecoin. But you look for some way to get to a dollar. Frankly, a dollar is a stronger fiat currency as a result of us having raised the interest rate. It was getting stronger again. People moved to Tether. They didn't fully understand what it was, but what they knew was that thing's a dollar. I can get it. And when countries start to have trouble with their local currencies, you tend to see the same patterns. the first thing that happens is the inflation spikes up. And then the government denies that the inflation is as bad as it is. And the people all feel it. They're like, I can feel it, but the government's not telling them the truth. The next thing that happens is the people start clamoring for something else, usually the dollar. This makes the local government fearful. And they're like, lock the exits, turn off the dollar. You can't get your dollars at your banks anymore, right? And then you have two currencies. Actually, you have like the actual price of the local currency, and you have the government price of the local currency. And so you end up with a black market. Now, the people just have to live, right? They're just paying rent and doing their regular stuff and buying food, et cetera. They don't have a choice. The government can pretend that the inflation isn't happening, but it's happening. And they try to lock the exits, et cetera. All right. It turns out that Tether stablecoins are a delivery vehicle that can get through a lot of this stuff. This is in part why, governments are afraid of digital assets, is because we have a new type of asset that's peer-to-peer. It's no longer centrally controlled. And so they can't fully prevent it from moving around. And they want to control it for cases where they think that they can preserve value for themselves. It's always bad for the people, always. But anyway, that's where we're at. So look, I think we've seen it very clearly in Turkey. People want stable coins because it's better money. If you give them a strong US dollar with interest, that thing is going to get eaten up all over the globe. We actually don't have need for all these fiat currencies. A lot of these weak ones can disappear.
So fast forward 5 years, 10 years, time frame is irrelevant, just like a future period. Because saying 5 to 10 years in finance and in tech, in finance, nothing changes, but in tech, the whole world will look different, especially with all the techs that we have right now that are just exploding. What's the end state here? What does this look like? What do banks do? Are we going to see crypto, like Circle or Tether, are they going to become banks? Is it going to be more Robinhood and the fintechs that seem to be adopting crypto much faster than the traditional banks that are going to big players? World Liberty Financial, like they seem to be making a big push, and obviously with Trump behind them, I think they understand the power of stablecoins. I know this is a very big question I'm throwing at you, but I'm trying to understand how it's all going to fit together in the long term.
Well, look, BitGo has a stablecoin as a service product, meaning that we have all the infrastructure know-how. We can handle smart contracts. We can handle the mints and burns. We got the regulatory capability to do it in the U.S. and abroad. We got the money transmission. We can put audits around it. So, by the way, we handle 100% of USD1. It's a great product. They use that stablecoin as a service, and then they're out helping it work. We're making sure that the money is safe and audited and all that. So you can go to our website. We put out a new audit every month. Goes out. So there's room for competition for new stablecoins. I mean, everybody's got their strengths and everybody's got their weaknesses. This isn't to criticize them; it's just to say it's a fact. All right, in the Tether case, right? So Tether keeps 100% of the interest. They've done a great job building a global product. It's huge. They're executing well. USDC similarly also keeps all the interest, and it's a bit of a weakness. They share half of it back to Coinbase, which creates a conflict of interest sometimes in the market. That's also a bit of a weakness. And then lastly, the ability to have so many of these and to create them. So you got USD1 and others that are coming in to compete in various ways, whether that's on DeFi and products that give back more yield to clients or what, we'll see. I mean, I think one thing that's an obvious weakness of the existing incumbents is that, keeping 400 basis points, roughly the risk-free rate, as an administrative issuer fee doesn't really make sense. I mean, think about ETFs. We got the ETF from BlackRock, for Bitcoin and other stuff. They take about a 25 basis point fee. So the idea that an issuer of a stablecoin needs a 400 basis point fee seems a little high. Now, I get it. The early incumbents definitely deserve credit. They were doing build out. There's innovation, a lot of stuff to be done. It was done during a zero interest rate environment. So there's reasons why it is where it is, but there's a lot of room for competition. The banking system is barely started. Digital assets are, while they've grown, a tiny, tiny part of the overall economy today. So there's massive distribution channels that people can tap into. I can tell you at BitGo, we've got dozens of folks in the pipeline. They're going to be launching stablecoins of various forms. They have different reasons to do so. It might be local geographies. It might be interest rate returns. It might be particular sectors they want to hit. There's just a lot that's going to happen. So I think we're going to go through the short term, and the short term, I guess, I mean, 0 to 10 years. We're going to go through an explosion of new types of assets. They're all going to compete. They're going to duke out like what is the right type of stablecoin that retail likes the best, that businesses like the best. How many win in the end? I don't know. I would guess probably there'll be like 3 to 5 that are really big. Like everything, it'll have a long tail and a steep, concentrated sector that is most of it. Because at the end of the day, it's money, and it's easier to interchange if you can have it liquid everywhere. And building liquidity is really the value of the stablecoin. When you get a coin, whether it's USDC, USDT, USDG, Frax USD, USD1, any of these, what you want to know is you can take it somewhere and you can turn it back into $1 if you need to, or you can use it. And so the value of these coins is the network. It's the ability to have liquidity everywhere. So that's what's going to happen. There's going to be a big duking out, and you will see major U.S. financial institutions enter in the arena with their own stablecoins, and there'll be conversion between these, and that'll work. And then long term, where I think things start to change is we actually start to disintermediate banks more effectively. So this idea that a bank, a depository, is going to take retail money, be a terrible payment processor, give you 0% interest, and then lend it out to other people at risk that only gets bailed out by the U.S. government. This is going to completely dismantle. We needed that 100 plus years ago. 100 plus years ago, you didn't have computers. So, you're in San Francisco, or you're in LA, or you're in Chicago, whatever. You had a local bank you went to, and you deposited there, and he knew who you were. And also, he's lending out to small businesses and others. And he was making those determinations about how to do lending, sometimes rightly, sometimes wrongly. But he had to. It was all local. He had to know who he was lending to. Look, the mortgage industry, which is the largest lending borrowing network in the U.S., has already moved out of the banks. Basically, you go into the bank, they underwrite your loan, they write the paperwork. As you're walking out and the door is closing, boom, that thing has been packaged. It's been sold off to Wall Street and securitized, where it's got a much more liquid treatment than it could possibly have when just held at some small bank, even if your bank's a big one. So banks aren't really holding on to mortgages very much. What's going to happen is all lending is going to move to something similar. And by the way, we should move it all onto something blockchain based so that you have transparency about it. And then like those that want to buy debt, want to buy bonds, they go to an open market. It's going to be completely liquid. It'll be liquid all day long. It won't be a bank. It'll be instead, you've got private equity, you'll have corporates, you'll have retail can be in there. Whoever wants to buy bonds as part of their portfolio, and they can know what risks they're taking. There'll be different types of bonds. There'll be different classifications. But basically, every dollar of lending will be put into that system. And now, what is a bank? You don't really need a bank anymore. You get stable coins for the deposits. That's separate. And you've got lending. That's the other thing. That'll be separate. Now, this is going to take a long time. Banks are going to morph. Some of them will make this transition. Others won't. But that's what's going to happen. They're going to be completely disintermediated from where they are today.
In this adoption cycle that we're talking about, let me ask this. First of all, when the Genius Act happened, yourself and your executive team at BitGo, how much are you sitting there thinking like, oh, this is a big deal? And then what are the other catalysts or headwinds that you see in the next few years that you think, okay, yeah, these are the moments that could be tipping points in either direction?
Yeah. Well, look, the financial controls you hear about all the time, and we've got FinCEN and we've got OFAC. We have a number of regulators who are tasked with the daunting job of how to stop terrorist financing, how to stop fentanyl, how to stop sex trafficking. So look, at some level, we all, as Americans, we agree. Like, we want these things stopped. So, okay, great. And so in the U.S., we have this thing called BSA, the Bank Secrecy Act. It doesn't matter if you're regulated or not. Every American is subject to Bank Secrecy Act. It has to do with how you do money movement, and how do you make sure that you're not dealing with bad guys. But let's break down some of the controls here. And I think overall, the law enforcement elements of money, and this applies again to not just stablecoins, but everything, I think it's gone a little bit overboard, and their reasons are good for why they want these controls, but sometimes it's just not very good. For instance, you talk about fentanyl. Look, money has nothing to do with fentanyl. Like drug dealers, they obviously they figure out ways to trade bad stuff with other people using something. And the number one thing they use is US dollars, not stablecoins, right? Actually, stablecoins are more traceable than US dollars. They tried to use Bitcoin. They've kind of stopped using Bitcoin because that was way too traceable compared to US dollars.
Interesting. That's interesting. People don't realize that they've stopped using Bitcoin. It's a good point.
It's a loser. It's a way to get caught. But more interestingly, the idea that you're going to try to track drug dealers by way of money, you're like 3 steps away. So remember, here in the US, like in San Francisco, you deal drugs and you're back on the street like 4 hours later. So if you're not going to actually stop the crime, you want banks to go and figure out who the bad guys are and figure out where the money's being moved. Like it's a tough problem. It's indirect. Like if you're not going to do it at the direct point, like how can you do it at the indirect point? And this isn't crypto specific. Remember, you read all the time. TD Ameritrade got fined over $1 billion for some bad movements just, I don't know, 8 months ago. You hear about it, at least 2 to 4 times a year from traditional banks not related to crypto, that they can't prevent this type of stuff. It happens. They've got all the controls in there. They're trying to do business. Unfortunately, bad guys are tricky and they try to get through. So my personal opinion is that BSA should not be the place where we try to enforce general drug problems. Now, then let's go to the other two. Let's talk about sex trafficking. Let's talk about terrorist financing. Sex trafficking is kind of the same thing. Like you got to stop it at the source. Expecting banks to be the ones that stop sex trafficking. Look, it's not that we want to participate in it. We don't. It's just that you're asking us to surveil every American, every transaction. And yet, you're not actually stopping the crime directly. So I just think that's a fool's errand. I think they're on the wrong path there. I think they got to back off. Terrorist financing, of course, we all agree with. Like, we think about, what we see in the movies of somebody buying, a big boy nuclear weapon or whatever, and they're going to go use it. Of course, we want to stop this. And of course, we need to know who it is that's dealing with us. However, when you look at like modern warfare, it's drones. Right. And I've had talks at Treasury about, what types of things they're trying to capture. And they're like, hey, look, somebody can buy a $200 drone and do a lot of terrorist damage. It's terrible. Well, once you're down to the $200 transaction to be monitored, you're basically saying we need to monitor every transaction of every American all the time. And I just think that, you're in the wrong place at this point. Like, really? Like we need to just monitor every transaction that everybody ever does in case, there's one bad guy out there. It's not that I disagree that we should stop any of these terrible things. We should. It's just, I think the money system is not a good place to do it. And the evidence is very clear. It doesn't really work. Also, there's no accountability in the government. We have SARS, suspicious activity reports, which we as a financial institution are required to report. These things are so designed pre-electronics. It's hilarious. Basically, it's a piece of paperwork you fill out. Of course, you can fill it out electronically if you want. It's only due 14 days after the transaction. We can see in real time on the blockchain money moving way faster than you can through the suspicious activity report. And that's just to get it filed. You got 14 days. And then if it takes 14 days to file it, then the Secret Service picks it up. It might take them months before they actually look into it. Frankly, there's no amount of manpower. There's no amount of filing reports that's ever going to actually stop this stuff. And I think that's evidenced by the fact that the thing just doesn't work. And if you ask the government, hey, can you just show us the accountability? Like, hey, how much are we spending on this that is tracking all these transactions? And how much are you benefiting from it? Of course, they won't give you that report. Instead, they want just to forever grow it. All right. I've probably gone on too long. My point is this. I think the governments are well-intentioned, but they've gone a little bit off the reservation in terms of in their quest to get down to a $200 transaction being monitored. They've kind of forgotten just how much they've hindered Americans. And this is why payments are so bad at banks. We blame the banks entirely, but it's not entirely their fault. Mm-hmm. Banks have this horrible task, which is they're supposed to never, ever allow any single bad transaction through. And they're also supposed to never, ever freeze an innocent person's account. These two things are incompatible. You can have one or the other, but you can't have both. So if you've ever had your bank account frozen or, a weird thing delayed or whatever, it's quite likely due to one of these laws. And, we can complain about the banks, but it's not entirely their fault.
It's the regulators as well.
Yeah. You're now hearing this at Coinbase. Coinbase is trying to do a technology first approach, and they're running into the same oops. We tried to do what the government told us, but now we flagged this guy who's been a great loyal customer for 8 years. How do you do both?
So the regulators have broadened their scope maybe a little bit too wide. As we wrap here, Mike, when you look forward, let me actually bring it back to a crypto specific question here, because I think what's been great about this episode is it's been great to get you have such a great history mind and to take us back and to show us where we are now and where we're going. I think it's fairly clear, especially to our listeners, to understand where stablecoins are right now and where they're going to go in the near term. It feels fairly obvious. When you look at where that will be built within crypto, obviously, most of stablecoins are on Ethereum currently, right? Solana has also been a good place for stablecoins, growing there. Base is a booming ecosystem right now, and we've talked about Coinbase. I can't have an episode where they're not brought up. Where will the stablecoin economy exist? Is it going to exist on, I don't mean the actual stablecoins themselves, more so the blockchains or the infrastructure that it exists on? Will it exist in the same way that it exists today, or is there going to be a movement happening there in the coming years and decades?
It's going to go to whichever blockchain provides the best product. We've already seen this, right? So when Ethereum fees spiked high, we had a bunch of traffic move over to Tron for stablecoin activity. And if that type of thing happens again, where there's scalability issues on one, people will move to another. So look, I think that's open. I think it kind of doesn't matter. The stablecoins can be run across a number of networks pretty easily. By the way, here's kind of a funny one. Ripple has a stablecoin, RLUSD. Now, Ripple is also famous for having, why do they exist? They have this thing called XRPL, which is their layer one. Does RLUSD run on XRPL? A little bit. I think of their 600 million market cap, they've only got about 10% running on XRP. The rest of it runs on Ethereum, right? So what did they have to do? Well, they had to go to where the apps are actually running, and there's no apps significantly running on XRP. So they had to go do it on Ethereum. As they move up the stack, they themselves recognize that, no, actually the stablecoin needs to be working on the chains that are providing the most value. Ethereum is providing more value than Ripple, so they moved to Ethereum, even though they are Ripple, which is I think fascinating. We'll continue to see this duke out, but I think the ecosystems the L1s are fighting to bring in the best apps and the best ecosystems on their chain. Ethereum got in earliest, still has the bulk of DeFi to this day. Solana's made some good inroads. Sui's made some good inroads. Maybe the thing which doesn't exist very much on the L1 level is privacy. I'm happy to hear that there's more privacy being discussed now. I think we do eventually get to privacy chains. I mean, there's a real thing for the crypto heads, self-included, to think twice about, which is, for anyone that's not in crypto yet, they're like, okay, head around what happens with digital assets. And then they're like, well, wait a minute. So now everyone can see my transactions? And I don't want that. Okay. So look, that's a real thing we have to deal with. And today it's pretty much true. If you put all your assets on chain, people will see where you are. So I think that has to be fixed. And I think the L1s will compete to provide the best service to stablecoins.
Yeah. And the L1s will fix that, whether it be with ZK or some other new tech, which we've been talking about, recently. If you guys want to go back, check out the episode last week with Jake, where we talk all about ZK and the status of that. Mike, did you have anything else to add there?
Yeah, there's one thing I guess I skipped over. We didn't talk about, which is different types of stable coins. There's algorithmic stablecoins, there's one-to-one backed. So the Genius Act only allows for the one-to-one backed type stablecoins. I personally am only a fan of the one-to-one backed. There's always people that think they've built a way that tracks the dollar. I think Make or Die has done reasonably well, but there was a few years ago they had an existential threat. They bailed themselves out, so they survived. But the concept of it still exists. At the end of the day, because it's algorithmic, there's a tie back to Ethereum, and if the Ethereum price drops too quickly, they could fall out of whack and no longer be able to maintain the peg. They put in protections to protect against that, which is good. But in general, when you get into non one-to-one backed, it's a lot harder to tell whether or not you really have the backing or not. And people will say they do, like Terra Luna, and they didn't. But it's just tricky. So far we've only been talking about one-to-one. I think it's good that the government's confining it to that. But one interesting thing I do like to note, we have a bunch of stable coins that exist in traditional finance to the US dollar that have nothing to do with crypto. Some countries like El Salvador and Panama don't even have their own currency anymore. They just went straight onto dollars. Others like Hong Kong have a Hong Kong dollar, which is one-to-one backed. $2 is a ratio, but it is one-to-one backed. And then like in UAE, the dinars there are backed by a combination of dollars and oil reserves, which is effectively an algorithmic stablecoin. Fortunately, they have a lot of oil, so I don't think there's anyone that's calling it into question. But it's interesting. We have all these models in traditional finance. None of this is new.
It's very interesting. I'm going to end it there because you're now getting into. You make me want to talk about digital asset treasuries and the potential of them as using other digital assets for backing of their treasury, which kind of makes a parallel to oil companies. But I'm not gonna open that can of worms.
We could talk for 3 hours. Yeah,
Mike, this could go forever. Mike, just a pleasure to get you on the show today. Your big picture thinking is very enlightening. Thank you very much.
Thanks for having me, Jay. You run a great show, so it's my pleasure.
Appreciate it. Well, thanks everybody for listening in. I got to remind you, as always, none of today's episode is financial advice. I'm not your financial advisor. Mike is not your financial advisor. You should always do your own research. If you need help with your investments, you speak to an investment professional. As I mentioned at the beginning, if you're doing swaps with your crypto, check out Milk Road Swap at swap.milkroad.com. Some of the lowest fees in the space. Have yourselves a wicked awesome day. We'll see you back again tomorrow. Crypto still has two major problems. First, a lack of privacy. On-chain transactions are public by default. Second, using your most valuable tokens for everyday actions feels wasteful. Midnight solves both with a dual token system. Night is your store of value, designed to hold. Dust is what you spend, a private renewable resource used to fuel on-chain activity. You generate dust by holding Night. That means your value stays intact while your actions stay private. No more burning your bags, no more exposing your wallet to the world. And now the Night airdrop is live. Go to midnight.gd to claim yours and explore the ecosystem so you secure your spot before the Glacier airdrop phase ends. Check it out today. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only and nothing we say is financial advice. Investing in crypto or any asset is risky and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.